Something else that's really important is that when there is a sales charge, it is not an operating expense of the fund. The client bought the open-end fund share at 10. Ultimately, $9.15 went into the fund. Operating expenses of the fund include the largest expenses, the investment advisory fee, custodian fee, transfer agent fee. The commission is not an operating expense of the fund. They love that. They love that on the test. Valuing fund shares. Something that's interesting here, when we're talking about these open-end funds, we said they're always new issues. So they're like in this continuous primary offering. So this IPO all the time. And if you were going to go out there and buy shares of when Facebook went public, their IPO, you bought them at $38 a share. But what happens when we have this portfolio of securities, the prospectus, it can't say exactly what the price is going to be that you buy the shares at, but the prospectus is going to list what is the formula for the share price. So that the sales charge is 5% of the ask. What's the formula for the share price? And then there's this idea that bid plus sales charge equals ask. And that a synonym for bid is NAV per share, so NAV plus sales charge equals ask. So NAV stands for net asset value, so that a fund is required under the Investment Company Act of 1940 to value the assets in the fund's portfolio at minimum once each business day. When? At the close of business of the New York Stock Exchange. That's when they have to value the portfolio at minimum of once every business day at the close of business of the New York Stock Exchange. Now, bigger funds will do it once at noon and once at close of business of the New York Stock Exchange, but all funds must do it a minimum of once every business day. So what they do is they figure out the fund's total net asset value. So it's the current market value of the portfolio. If you knew the number of shares outstanding, that would give you the fund's NAV per share. So that there's this concept, NAV per share plus sales charge equals the ask. When somebody buys an open-end mutual fund share or they redeem an open-end mutual fund share, what price do they buy at or what price do they redeem at? The next price determined. If the market closes up 300 points today, everybody wants to get out, right? Not going to happen, meaning that you're not going to know what price you get until the close of the next business day. Forward pricing. You can't say, oh, I want that price. No. It's always the price next determined. Always the price next determined. So if we know total NAV and number of shares outstanding, you can figure out what the fund's NAV per share is. Conversely, if you knew NAV per share and how many shares were outstanding, you could figure out the fund's total net asset value. How often do you think the size of that balloon is going to change? All the time, every day, every single business day. So there's this concept of, so this is the portfolio, right? And I kind of talked about this already. What will make my NAV per share go up? What has to happen to the actual assets in the portfolio? What do they have to do? They have to expand. The balloon has to grow. So NAV per share increases if the assets in the portfolio appreciate, which the opposite would be true as well. What will cause my NAV per share to go down if the assets in the portfolio depreciate? So the test likes this concept of what are called net purchases and net redemptions. Net redemptions. Net purchases and net redemptions. So what happens sometimes is that mutual funds sometimes become popular, and a lot of dollars start to flow into the portfolio. So net purchases occur when more dollars go in than are coming out, then go out. I know that's not the best English, but you know what I mean. It's really what happened is the fund became a popular fund. So we have all of these dollars, more dollars, more dollars, more dollars, more people investing in the fund. When we have a net purchase, what happens to NAV? Total NAV goes up, right? The balloon gets bigger because we had this mass inflow of dollars. But what happens to NAV per share? Nothing. It stays the same. Why? Because we have more shares outstanding. So they love this concept. Just because the balloon got bigger, if the balloon got bigger because of more people investing into the fund, your share price stays the same. And the same is true on this side. In net redemption, it's just the opposite. A net redemption occurs when more people leave the fund than invest in it. The new dollars coming in. So the balloon's going to get smaller in a net redemption situation. The portfolio is going to depreciate. Total NAV goes down. But what happens to NAV per share? Because a lot of times investors, there's this misunderstanding. They think that if people are pulling their money out of the fund, it's driving their share price down. No, their NAV per share remains the same. It remains the same. What's driving the NAV per share down is depreciation of the assets in the portfolio. Let me show you the world's smallest mutual fund. Pretend. Let's say it had a total NAV of $500 and there were 5 shares outstanding. What's NAV per share? $100. NAV per share, $100. And let's say that 2 shares are redeemed. So if 2 shares are redeemed, what's going to happen to our total NAV? Well, it's now 300. NAV 300. How many shares are left? 3 shares. And see, look, in my simple math, I proved it to you. What happened to NAV per share? NAV per share, it stayed the same. 300 divided by 3 is 100 still. So sometimes just seeing that mathematically helps us to understand the concept that's so important for the test. So your share price goes up because of appreciation. Your share price goes down because of depreciation. But your share price does not change by a net purchase, nor by a net redemption. We talked about the maximum sales charge allowed under FINRA rules for a load fund. Maximum sales charge is what? 8.5%. So I write it both ways just in case you see it that way on the test. 8.5%. But in order for a fund to be able to charge 8.5%, certain provisions must be met. If these 3 things are not met, so there's going to be 3, then the maximum sales charge that may be charged is 6.25%. So in order to charge the maximum sales charge, which honestly most funds do not charge anywhere near, they have to meet certain requirements. They have to allow for the automatic reinvestment of income distributions at NAV per share. So this is without a sales charge. And I sort of talked about this already. The income distributions, those are your dividends and your capital gains. So that's one of the things that they have to do if they want to charge the maximum sales charge. They also have to have a schedule of breakpoints. Breakpoints are for lump sum purchases, reduced sales charges. They also have to allow for what we call, because not everybody can put in a lot of money all at once, the right of accumulation, which says that if your account balance has gotten to a certain place with your next investment, you get over the break point. We charge you a reduced sales charge going forward. So those are the three things that the fund must do to charge the maximum sales charge allowed. The sales charge and sales expenses are paid from the sales charge collected by the underwriter. So there's that whole concept again of when there's a load, it's collected by the underwriter. Commissions are paid out of the load, as well as all sales and advertising expenses. So the cost of preparing the sales and advertising material is actually borne by the underwriter, the dealers, the people involved with selling this new issue. So we talked a little bit about this already, but I want to make 100% certain that we're all together on this concept of the maximum sales charge allowed under FINRA rules is 8.5% of the ask price. So if the ask is 10 and the maximum sales charge is charged, then 8.5% of 10 is 85 cents, and the bid price would be $9.15. So bid plus sales charge equals the ask. So bid plus sales charge equals the ask. Remember some synonyms for bid: NAV per share. So the test can use these things interchangeably. You just have to be ready for that. A synonym for NAV per share: redemption price. So the ask price, also known as the public offering price, also known as the offering price. The load, also known as the sales charge, also known as the commission. So that all of these are the same formulas. We could say redemption plus load equals ask. We can mix them all up, right? So you just feel comfortable with the columns. And I know I already talked about this, but it is something that the test does really like. This idea that when you pay the ask, if a load is charged, open-end fund, the ask includes the sales charge. So your cost basis always includes the sales charge. We find in the prospectus the formula for computing the actual cost of the share. So we find, generally speaking, you'll find the sales charge listed as a percentage of the ask and a percentage of the bid. So should the test ever ask you for what's the sales charge as a percentage of net asset value, because it can ask that, you take the 85 cents and you divide by 9.15. So that's going to be more than 8.5%. It's only a violation of FINRA rules if the sales charge is more than 8.5% of the ask price. So it'll list the sales charge most oftentimes in the prospectus both as a percentage of the ask and as a percentage of the bid. Now every once in a while they're going to give you a fund's net asset value per share, and what is their sales charge as a percentage, and then they're going to ask you to tell them what is the ask price. So a common mistake that people are going to do is they're going to take the sales charge and they're going to multiply it by NAV per share. The assumption is always that the sales charge is expressed as a percentage of the ask, not of the bid. So what's the formula? So for example, a fund's NAV is $9.50 and the sales charge is 5%. Okay? So there is a formula that you need to feel comfortable with to figure out what is the ask price. So we know we can't multiply because the sales charge is a percentage of the ask, so it becomes a division problem. So we take the bid price, the NAV per share, and we divide by the complement of the sales charge. So 100% minus the sales charge of 5% gives us a complement of 95%. So 950 divided by 95 gives us an ask price of 10. Now, there's this thing about math, it's so beautiful. It's like magic, right? If you did it right, 5% of $10 is what? Yeah, 50 cents. So 9.50 plus 50 cents is $10. Did we do it right? Yes. So I always double check my math. So just remember, if they give you NAV per share and the sales charge, don't just multiply them. It's in fact a division problem. Take the NAV, divide by 100% minus the sales charge as a percentage, and that will tell you what the ask price is. So sometimes you'll see a question like that and sometimes not, but just in case you do, you'll know how to get it right. Generally speaking, if there's going to be a load, it's going to be a front-loaded sales charge. But there is also the ability to have what we call a back-end load or a contingent deferred sales charge. A contingent deferred sales charge. So there's this idea, the industry's really kind of evolved around what do we do as far as sometimes it's a front load, sometimes it's a back load. What's kind of evolved out of the industry is what we call classes of shares, right? We talked about that earlier in one of the previous sections. Classes of fund shares. So that Class A shares, generally speaking, those are the front-loaded sales charges, where Class B shares, that's where you find the contingent deferred sales charge or the back-end load. So the idea of this back-end load is, hey, let's put your money in where bid equals ask. Okay, so there's no sales charge when you buy your shares. There's no sales charge in the beginning. If you want to take your money out, you have to really read the fund's prospectus. If you're going to take your money out early, when you take your money out, we're going to charge you a sales charge on the NAV per share. Oh, there's a little bit more to it, but just hold on here for a second. So if you take out your money too soon, you're going to pay a back-end load, a contingent deferred sales charge. Thus, Class B shares are best for someone who's going to keep their money in for long enough that they will automatically convert from B to A shares. But when is that going to happen? You have to read the prospectus. It could be in 5 years or 7 years or 8 years, or it just depends upon the fund. So that if you hold on to those shares long enough, when you bought them you had no sales charge, and then they convert into A shares, which when you redeem them, there is no sales charge because Class A shares were front-loaded. So that you might not pay a sales charge at all. In exchange for that, however, the Class B share, which is where most generally speaking we find a contingent deferred sales charge, has the highest 12B1 fee, which we're going to talk about in just one second. So this idea, when someone purchases mutual fund shares with a contingent deferred sales charge, it has to say on their confirmation, upon redeeming these shares, you may have a sales charge. Read your prospectus. It will describe in the prospectus what the sales charge would be upon redemption and how long the holding period would be to not have a sales charge upon redemption. So eventually it will go down to 0. When you, let's say that you do decide to redeem your shares and there still is a sales charge. So shares are always redeemed at net asset value, okay? So basically when you buy your share, you're buying with bid equals ask. So 9.15, to use my example from before, 9.15, so they're the same thing. So when you redeem, your sales charge is based upon NAV at purchase or redemption, whichever is less. So that's an interesting concept. If we think about this, whichever is less. So if you bought it when bid equals ask in 9:15. And when you redeem at the NAV, let's say you redeemed 3 years later at $11.15, your sales charge is going to be based upon the net asset value at purchase. It's whatever is less. If when you redeemed net asset value was $8 a share, then your sales charge upon redemption is going to be based upon the $8 a share. It's whichever of those two is lower. Thus, you're never paying a sales charge on appreciation. You are never paying a sales charge on appreciation. Now, it's important not to confuse a back-end load, a contingent deferred sales charge, with the fact that some funds, especially no-load funds, will have a redemption fee. So a redemption fee generally is a small percentage, like half of 1%. It's an administrative fee that's charged by some no-loads when you redeem your shares. So it's not a sales charge, it's just a redemption fee. Where would you know if your fund has redemption fees? You'd want to read your prospectus, of course. You'd want to read your prospectus. So what ended up happening is there was a lot of bad press, if you will, about loads. So loads became kind of this evil thing. And I don't know if that's necessarily true. I think they might get a bad rap. Somebody's got to sell things and, feed their families and things like that. So what mutual funds ended up doing is they said, well, if we want to be a no load. But if you remember, the load paid the commission for the person who sold it, as well as paid for all sales and advertising, because the sales and advertising expenses were borne by the underwriter, by the sponsor, by the distributor of the issue. So that when there's a no-load fund, how does the fund reimburse themselves for these expenses associated with distribution of the shares? So basically what ended up happening is the funds created an asset-based fee, and the SEC kind of figured out what was going on and made up what's called SEC Rule 12b-1. So what we're discussing here are called 12b-1 fees. So this is an asset-based fee that's used to pay the cost associated with distribution of the shares. Distribution of the shares. So this potentially is a fund that says, look, we don't charge a sales charge. But if you were to look at one fund that has a 12b-1 fee and one that does not, which one has higher operating expenses? The one with the 12b-1 fee. The higher their operating expenses, what did we say about their yield? The lower their yield. So the less they pay out in the form of dividends, which has an adverse effect on your client's return. So it's almost like, I'd say no load, no 12b-1 fees. They're both bad. They're kind of equally bad. Almost worse, a 12b-1 fee, because if you pay a load, let's say it's a front-loaded sales charge, how many times do you pay the load? Once, when you bought the share. When you have a 12b-1 fee, it's an operating expense. So 12b-1 fees, we sometimes call them trailer fees. They're operating expenses that have the effect of lowering the dividends for as long as you own the share, that have the effect of increasing expenses and thus decreasing dividends. And not just for 1 year, for the life of, for however long you own the share. For however long you own the share. Granted, if you had a Class B share, at some point the Class B share is going to convert to a Class A share. So Class B shares have the highest 12b-1 fee. They have the largest operating expense. So it's really important that they do convert to Class A shares at some point, based upon whatever the prospectus says. So they're perfectly allowable. There was this period of time kind of before the Great Recession where the SEC was looking into changing the name for 12b-1 fees into being asset-based sales charges, because that's what they are. But then the Great Recession happened, and that kind of fell along the wayside with the implementation of the Dodd-Frank legislation. So there's been so many other things that have come up that have been much more important than, do investors truly understand what a 12B1 fee is and how it affects them? I don't know. It's your job to really understand how it works and help them understand when they choose. You have to give the best advice you can, the best for your clients when you're making a recommendation, of course. And one of the things to understand is how a 12B1 fee works. So trailer fee, it happens year after year after year. There's been a lot of litigation about investors that would have been better off in Class A shares, better off paying that front-loaded sales charge. Not to say that you can never offer a Class B share, but a lot of funds don't even offer them anymore because of the concern around them. So funds can have a 12B1 fee. It would be disclosed in their prospectus. We call them a 12B1 plan. Ultimately, even though the 12B1 fee is an operating expense of the fund, who pays the cost of the 12B1 fee? Who? Yeah, the shareholder does, because the shareholder gets less in the form of dividends. When a fund wants to have a 12B1 plan, the plan must be approved initially and reapproved at least annually by a majority vote of the fund's outstanding shareholders, the board of directors, and those directors who are not interested persons of the investment company, which we learned the rule 40% must be disinterested. Now, there is this rule here. So the concern would be that a fund that doesn't charge a load but has a 12B1 fee can't charge a super huge 12B1 fee and still call themselves a no load. So if a fund charges more than 1/4% of net assets managed as their 12B1 fee, then they cannot call themselves a no load. They cannot call the fund a no load because in fact, they're not a no load. So if a fund charges more than 1/4% of net assets managed as their 12B1 fee, then they cannot call themselves a no load. So I don't really care what the 12B1 fee is as a percentage of operating expenses. I don't care if it's 10% of operating expenses or 0.03% of operating expenses. It's when it's more than 1/4% of net assets managed that it becomes a violation of the rules for the fund to call itself a no load.